Welcome back, everybody. One thing about doing stock analysis and being able to continue learning over time is that it's important to go back and evaluate how well your analysis turned out. And that's especially true for stocks that you didn't end up buying, because otherwise, how would you know that you made a good decision or not? So in this video, we're going to go back and look at 4 stocks that I analyzed in 2023. We're going to review my analysis at the time, and then we're going to see how the stock and the business has been doing since then. And then ultimately, I'm going to give myself a letter grade for each one just to make it a little bit more fun. So let's go ahead and get started. And just real quick, remember, anytime you're grading your analysis, whether it's 8 months later, 10 months, even a year, it's just a point in time. I mean, you can have analysis that after a year seems wrong, but then after 2 years, it was actually right. So these things are constantly changing and evolving. And what we're doing here is for learning purposes, but just know that it's just a point in time and these things can and will change over time. Okay, so first up is Texas Roadhouse. And I've talked about this one already at the beginning of the year, but let's review what I said in my original analysis on November 8th, 2023. In terms of business, Texas Roadhouse has revenue growth that's greater than 10%, and they've been extremely consistent over the past 10 years. They have cost increases which could potentially impact their value proposition and are in a narrow mode industry. So from a business perspective, I would rate them as okay. In terms of operational performance, their free cash flow has funded their expansion, buybacks, and dividends, with dividend growth that's greater than 15%. Plus, they basically have no debt, with only capital leases on the books. So from an operational performance perspective, I would rate them as good. From a valuation perspective, their DCF model is about 64% of the current price, and their price to earnings and price to cash flow look close to fair value, but not quite as attractive as they were about a month ago. From a valuation perspective, I would rate them as okay. So would I rate Texas Roadhouse as a buy? So for me personally, Texas Roadhouse would not be a buy, even though they're doing a lot of things as a company that I really like. But I have some concerns with their overall outlook, and let me explain what I mean. Here's the things that I like about their business. Texas Roadhouse has shown very good revenue growth for a decade. They have strong comparable sales numbers, even in 2023, which show that they still have traffic and have pricing power, at least so far. They have basically no debt, and they've been funding expansion, buybacks, and dividends with their cash flow. They've had excellent dividend growth at greater than 15%. And in general, I like Texas Roadhouse's core strategy of value plus experience. And I mean, that's a really strong list of things that I like. But even though I rated their business as okay as opposed to good, it was really close. But the reason for that is because of the things that I don't like. And first off is rising commodity costs, beef especially, which is going to hit them harder than some of their peers, along with rising wage and labor costs, and in general, slim overall margins. And all three of those directly impact their core value proposition, especially if we get into a situation where people are spending less. And so since this analysis, Texas Roadhouse went from about $103 per share to $169 per share, with a total return of over 65% compared to the 21% return of the S&P 500 during that same time period. So clearly I got this one wrong, but what actually happened? Well, Texas Roadhouse is one where I really focused way too much on the macro environment. I thought the economy was going to slow down, even though it wasn't really in their actual numbers yet. So their business rating I put as just okay, but it really should have been good. And my thoughts about how consumers were going to be trading down to McDonald's and maybe even Starbucks really kind of missed the point. Because what was actually important was this: interest rates were higher and planned to be higher for longer. That means companies with a lot of debt, like McDonald's and Starbucks, would likely trade lower, and they have. While Texas Roadhouse has traded up, at least partially because they have no long-term debt, and they're not going to be as impacted by rates directly. So if you're going to factor in macro to your analysis, just make sure you're factoring the macro that actually exists and not ones that you're trying to predict. Because had I just taken Texas Roadhouse on its own merits and not trying to predict what the consumer was going to do, it would have ended up being a much better approach. So overall, this ended up being one of my worst analysis examples from last year. So in terms of a grade, I would have to give myself a big fat F. Okay, so next up is Crocs, and again, this is one that I talked about in a later video, but let's go ahead and review what I said in my original analysis on September 18th, 2023. So when it comes to business, Crocs has revenue growth that's over 20%, and if you just take organic growth, it's over 10 to 15%. They have customer loyalty, they have some intellectual property, but they're in a very unpredictable industry. Still, based on the fundamentals and their popularity right now, I would put their business as good. In terms of operational performance, they are seeing good free cash flow growth and they have relatively strong margins, but their debt position is too high, and to me that presents a significant risk. So their operational performance I would rate as okay. Now, in terms of valuation, the DCF model is over 2 times their current price, and their price to earnings and price to cash flow metrics are both under 10. So for me, valuation definitely looks good. So is Crocs a buy now? So I have Crocs as a buy, but it depends on what type of investor you are. Because Crocs is a mid-cap growth company with a beta of 1.66. And what that means is that there's going to be a lot of volatility and wide swings in their price compared to the broader market. Now, for example, when I first evaluated Crocs for the stock analysis library, it was trading at $93.37. And over the past week, it's dipped almost 8%. So if you're someone who's looking for a consistent dividend payer that's going to just consistently grow slowly and not have wide price swings, this is not for you. But if you're looking for growth opportunities, I think Crocs is an interesting company, because rarely do you see growth companies with good margins trade for such low price metrics. And since that analysis, Crocs has went from about $87 a share to $149 a share, with a total return of over 75% compared to the almost 20% return of the S&P 500. And so this was an interesting one because technically my analysis was good. I had it rated as a buy, but then I didn't actually buy it myself, because Crocs was one that really hit all the measurables except for debt, and the company actually had a plan to start paying that down. But I didn't end up buying it because it wasn't paying a dividend, and my portfolio was supposed to be focused on dividend growth companies only, which is a dumb reason not to buy it. But I also wasn't sure of their moat and if they were really just a niche product, which something that I've actually backtracked on since. I actually have 2 pairs of my own Crocs now, and I really love them. So this is a really good example of where you can do all the analysis right, you can have the right idea, but if you ultimately don't execute on it, then you don't benefit from the work that you did. And out of the 4 examples in this video, this ended up being the biggest gain that I missed out on. But I'm a little torn because the analysis I did was actually really good. I just didn't pull the trigger on it. But hopefully some of you out there actually did. But in terms of a grade, I would still give myself a B- with just a note that says, hey dummy, just buy the thing next time. All right, so next up is Nike. And let's review what I said in my original analysis on September 11th, 2023. So for business, Nike has iconic brand power. They have revenue growth at about 10%, and they do have some niche competitors, but in general, they're the market leader. So on a business side, I would rate them as good. So in terms of operational performance, Nike has dividend growth that's greater than 10% on multiple timelines. They have low net debt, but they do have margins that seem to be decreasing with some economic headwinds coming up. So in terms of operational performance, I would just rate them as okay. So in terms of valuation, the DCF model returned a fair value price that was 56% of the current price. Both of the multiples models also returned fair value prices that were quite below the current price, and even the pricing metrics, especially price to earnings, seem elevated. So from a valuation perspective, I would rate them as poor. So is Nike a buy now? So for me, Nike is a hold right now, not a buy. So while there's areas of their business that I really, really love, there are a couple things that I have some questions and concerns about that I want to wait and see on. Nike is an iconic global brand that is far and away the leader in their industry. While they maintain some pricing power due to the strength in their product lineup and high-quality endorsers, footwear and apparel retail is a tough business, and that could be impacted by a slowing economy and more niche competitors that target a part of their customer base, like Lululemon and Crocs. And again, neither of those companies can compete with Nike on a broad scale, but what they can do is chip away at certain parts and segments of their customer base that are more drawn to the premium branding of Lululemon or the infinite customization and personalization options of Crocs. And I know that might seem like a small thing, but to me it's important because it clearly differentiates them in the market. And when we're talking about people having to make choices when it comes to what they're going to spend their money on, that definitely matters. Up to this point, though, Nike's growth year over year has been good, but it seems to be slowing in the most recent quarters while costs and expenses have risen. And now that's something that I just want to keep monitoring to see if it's just a blip or a trend that's going to continue. Which also goes for margins as well. Even if they expect SG&A to rise, what I'd like to see is a shift to more Nike direct revenues to help improve margins instead of having them continue to decrease. Now, since that analysis, Nike has went from about $97 a share to $94 a share, with a total return of negative 1.4% compared to the 19% return of the S&P 500. So at first glance, since it's obvious that Nike has been negative since my video, you could say that my conclusion not to buy was a good one. But let's take a look at some of the things that I mentioned. The slowing revenue growth trend has continued for Nike, as well as increased operating costs, even as revenue has gone down. A quick look at their margins, though, shows that they're on the upswing, which is a good sign. But ultimately, their growth and projected growth has dropped by a lot. So the good news in terms of my original analysis is that a few of the things that I was worried about that I just wanted to keep monitoring were part of the things that continued getting worse for Nike over time. Nike is still a strong brand to me, and I think that as consumer health improves, they'll likely improve as well. But I was still surprised to see that their Nike direct-to-consumer revenues were flat from when I analyzed it last year, and only up slightly as a percentage of revenue from 42% to 44%. To me, that's an area that Nike really needs to keep improving. So overall, this analysis turned out to be pretty good. Deciding to wait and watch their revenue trend was a good idea, and ultimately the stock has done pretty much nothing as the broader market has been up big time. Now in terms of a grade, this analysis was pretty solid and played out the way that I expected, so I'd actually give myself an A. Okay, so last up is Disney. And let's review what I said in my original analysis on August 11th, 2023. So in terms of overall thoughts, Disney is a tough one because if they weren't Disney and they didn't have all these premium assets and intellectual property, I probably wouldn't even be looking at them because where they're at from a fundamentals perspective, all the drama they have surrounding them right now, it's not something I'd be interested in. I probably wouldn't even consider it. But they are Disney, and that's what makes it interesting. I love the Disney brand, and I do think at some point, this probably turns around and is a great stock again. And I really love the ESPN bet idea, and I'm interested to see how that plays out. But the main issue for me is that when you think about the future of Disney, all those things that are supposed to be the future of Disney aren't even the things that are keeping them afloat right now, or even doing that great. You have streaming subscriber growth stagnating, although they are increasing revenue per customer, and that's good. But their direct-to-consumer business isn't even profitable right now. So anytime that we celebrate decreasing losses, I just kind of cringe a little. Like, yes, it is better. It's an improvement. But at the end of the day, the goal is to be profitable and make money. And right now, that part of the business just isn't. You have parks that are doing okay, but again, they have more headwinds with all the political nonsense surrounding them. And that really brings me to my main point about Disney. When I invest, I want to feel confident about the company that I'm putting my money into. I want companies that are strong and profitable, have really wide moats, and low drama. And right now, Disney only has one of those things. And yes, they are technically still profitable, but not in the areas of the business that are supposed to drive their future. And that's what worries me. So for me, Disney is not a buy now. There's just too much uncertainty around their business that it outweighs all those amazing assets and IP that they have, at least for me. I would want to see the turnaround actually happening in the financials. Maybe they get to a point to where they're paying a dividend again, but by that point, they're going to be up, maybe 30, 40, 50%. And that's okay. My goal isn't to catch every company at its lowest point. It's to buy growing, profitable companies. And right now, Disney's just not that. Now, since that analysis, Disney went from about $89 a share to $102 per share, with a total return of almost 16% compared to the 19% return of the S&P 500. So Disney's been an interesting one because it was actually on a tear and was outpacing the S&P for a while before coming back down. But I think this is a good example of where you can do your analysis and it can be right at the time, but with companies and markets, they're always changing and evolving. Because I said that I thought at some point they'd turn it around and hopefully reinstate their dividend, maybe get some growth back, but at that point they'd likely be up about 30 to 40% in stock price from where they were at the time. Now, what Disney has done since my original video, they've reinstated their dividend in November of last year. They're seeing some growth in Disney Plus again. Their direct-to-consumer business actually got to profitability this past quarter, and as far as I can tell, they've stayed out of the political news. So really, all the things that I wanted to see from Disney to kind of signal that they're turning it around are the things that are happening, which is pretty cool. And while they're not up 30 to 40% in stock price anymore, they were up about 35% back in April. And so this Disney analysis actually ended up being pretty good. And while I said I wasn't interested in them as a turnaround, now that they're beginning to turn it around, it might be time for me to revisit. So in terms of grade, this might have been my most accurate one of the four in terms of actually evaluating Disney's business and their stock price. So I'd have to give myself an A+. All right, so out of the four stocks, I had one big F, a disappointing B-, a solid A, and what I thought was a strong A+. So overall, not too bad in actually evaluating companies that I didn't end up buying. And there was actually a few really good lessons in there as well. Like evaluate companies on their merits and don't try too hard to predict macro. Or if you're going to use macro, make sure you focus on the macro that actually exists. And all the analysis in the world won't actually help you if you don't take the risk and buy. And then lastly, even if your analysis is good, it's an ever-evolving and moving target. So if there are companies where you say, hey, this is a turnaround, I'll just wait till they start performing better, you can't just assume it'll be right forever. At some point, you have to reevaluate and see where they're at. So what did you all think of the grades that I gave myself? Would you have rated me differently? Let me know down in the comments below. Now, if you want to watch my full analysis I did on Disney back last year, and just keep in mind the style of the video might be slightly different than what you're used to now, but if you want to watch that, you can click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see y'all on the next one. Peace.